Welcome to the monthly 3-Edge View from the Edge for January 2024. I'm Fritz, Folts, Chief Investment Strategist. Joining me here today once again is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. Before we begin, on behalf of everyone here at 3-Edge, we would like to wish everyone the very best in the new year. So let's get started, and as we do each month, Eric and I will provide our firm's most recent outlook for the markets, which is based on our proprietary model. But before we get to that, we'll take a brief look back at activity in the global capital markets during December, where the rally that began in early November continued into year-end. And it wasn't just markets here in the U.S. that had a strong month of December. Global equities also continued to move higher as investor sentiment swung decidedly away from concerns about higher interest rates for longer and towards a new narrative that the Fed's tightening cycle is now over and rate cuts are on the way for 2024. And in December, it wasn't just equities that had a strong month. Longer dated U.S. Treasury prices rose as their yields declined, and gold was positive for the month. Then, of course, Eric, there was Bitcoin, which was up, I believe, almost 20%, maybe more in December, and came in just shy of 150% gain for the year. But as we look back on 2023, the year may be best remembered for the economic recession that most everyone expected never materialized. And last year, as it came to a close, the economy and the labor market continued to show remarkable resilience. Inflation continued to decelerate, and yield on longer dated treasuries continued to fall, meaning bond prices rose. And so, as we enter 2024, the question among investors is, when will the hoped for cuts in interest rates by the Fed arrive? And, of course, can the Fed stick the landing and complete their goal of a soft landing whereby they tame inflation without causing a recession? So let me bring Eric here now into the conversation, and let's begin, as we always do, by looking at our asset class matrix to see what may have changed from the prior month.
That's great. Thanks, Fritz. Yeah, so we can see here on the asset class matrix, there's just a little bit of movement. We're seeing Japan and the EM/China move down to that mixed level, joining the US and India in that space. You're seeing rates move actually up into that positive one slot. So, the overall look from the 50,000 foot view here might be that we're a bit less optimistic on equities. I'd say many of these mixed are kind of in that mixed to positive, and we'll get into the details ahead. Here we go.
Good. Excellent. All right. So let's do that. Let's dig in. Look at the major asset classes. Why don't we begin with U.S. equities, which, thanks to a handful of mega cap tech stocks, had a very good year. But what is the model research indicating now as we enter into the new year?
Yeah, no doubt that Magnificent Seven were largely responsible for most of the U.S. equity markets gains. They finished the year strong. The S&P 500 just shy of its all-time highs, up over 26% on the year. The NASDAQ 100 exceeding its previous high, actually from 2 years earlier, and up over 55% on the year. Pretty impressive. No doubt, following the November Fed meeting, the narrative on the market shifted dramatically away from the fear of higher rates for longer to calls for as many as 6 interest rate cuts by the Fed in 2024. And this positive investor psychology contributed to that year-end rally we witnessed. The S&P 500's move higher throughout 2023 was also driven from that excitement around those mega cap stocks and the enthusiasm over this game-changing potential of generative artificial intelligence. So what are we looking at into 2024? Is the S&P 500 priced for perfection in an environment where risks are still present, right? We still have this mixed outlook here. The yield curve has been inverted. That is, short-term interest rates are higher than longer-term rates. It's been over a year now like that. In the past, an inverted yield curve has been a reliable forecaster of a potential slower growth and often a recession, as you alluded to, Fritz. Though, as we've noted, the Fed's recent monetary policy pivot could support a continuation of this rally in equities, which is why there's still some optimism. In that vein, we favor U.S. small cap value equities, which have underperformed the large cap counterparts and offer much more attractive valuations relative to, say, those Magnificent Seven large cap growth stock names. So mixed outlook for U.S. equities remains, but it's being supported by positive psychology that we've seen. But there's risks from the inverted yield curve remaining. So you can kind of see it's this pull and push from both sides.
Excellent. All right. So now let's look at Japanese equities. Also had a strong year of performance in 23. Seemed that our model maybe was becoming a little less positive towards Japanese equities as we came into the end of the year. But what are we seeing there now?
Yeah. Japanese equities enjoyed that strong year of performance, up over 19% on the year. Our current outlook is somewhat favorable. The mix that we talked about, the research signals some caution ahead based on the measure of the rate of change of the Japanese yield curve. So it had been steepening somewhat with the release of the cap by the BOJ on the long end of the yield curve. And then, that created some steepening, and investors since have actually backed off somewhat. And we've seen that yield curve actually flatten back a little bit, reducing that optimism. So small cap equities in Japan could be interesting as they are a bit more undervalued relative to their large cap counterparts, much like in the US, potentially attractive based on the potential for that Japanese central bank to relax its yield curve control further, which could cause a strengthening of the Japanese yen. We've seen that, people trying to get in front of that. In such a situation, this could be a headwind for large cap Japanese exporters, but perhaps less problematic for smaller Japanese companies that are more focused on the domestic market, who may actually benefit from a strengthening yen.
Excellent. All right. Well, let's shift our focus into Europe, where last year, in spite of a rather difficult economic environment, European equities, they did quite well. But what's our outlook now in 2024 for European equity markets?
European equities rallied in the final months of the year, as we've touched on, as everything rallied. Mainly to that positive investor psychology and equity market momentum, even in the face of what seems like mounting signs of economic weakness across the Eurozone. We just saw the inflation print come out a bit higher there this morning as well. European stocks finished up over 18% for the year. By the end of October, though, they were nearly flat on the year. So there's been quite a bit of volatility in that market. Overall, the outlook does remain negative, largely based on the current shape of the yield curve as we calculate it, which indicates just the potential for a slowdown and a potential recession in Europe.
All right, good. So now let's talk about China and the emerging markets. And China was kind of interesting in that at the start of last year, there was a good deal of enthusiasm around the prospects for Chinese equities as China emerged from the COVID lockdown. But obviously that wasn't the case. Chinese equities really struggled in 23. However, emerging markets ex-China did have positive returns last year. So what is our model research indicating now for EM and China equities going forward?
Yeah, it's been interesting to see the performance gap there, that emerging markets can stand on its own two legs without the support of China. The equity markets, no doubt, Chinese equity markets, no doubt, disappointed investors. The hope for recovery from those strict COVID lockdowns never materialized. We saw large Chinese property developers and that whole sector really continue to struggle. And there's just been nonstop reports coming out about excessive debt levels, broadly speaking, both public and private debt in China, which remains concerning. Emerging market equities ex-China did have that positive year of performance, depending on the index you look at, up almost 19% on the year. The direction of EM in 2024 will depend, on whether the Fed does indeed ease monetary policy and cut short-term rates here in the U.S., which will impact the value of the dollar. And should the Fed satisfy market expectations and begin to cut rates, EM equities could benefit. Any rally in the U.S. dollar alongside this could weigh on emerging market equities, though, who often issue their debt in U.S. dollar denomination, and then may make it even more challenging to service those debts, particularly with higher rates. That said, Chinese equities still show some potential. This is why we're still, in this mixed camp. Compared to the U.S. equity market, Chinese and emerging markets continue to represent an undervalued asset class. Chinese equities peaked in the February of 2021 and have been down well over 50% since then. So pricing in a substantial amount of bad news already. And, along with attractive equity valuations, the Chinese government remains focused on supporting its economy and stock market through a variety of stimulus measures. None have really been substantive enough yet, maybe to convince market participants to get in a big way, but they continue to ramp up those interventions, which could be supportive of both Chinese and emerging market equities.
Excellent. Okay. So the last of the equity asset classes is India equity. What is our model seeing there in terms of the India equity market for 2024?
Yeah, along with other global equities, India's equity market also rallied in those final months of the year, finished 2023 up over 17% after spending the first 5 months of the year actually negative. So really, really impressive turnaround there. The long-term outlook for Indian equities from our perspective remains favorable. Nearer term, our model shows India's equities remaining a bit overvalued, and the yield curve measure we construct for the region is weighing a bit on India's shorter term economic prospects or the potential. So, mixed to positive like the other equities we talked about.
All right, great. All right, so now we'll shift gears away from equities and look at the fixed income in the bond market, which was actually kind of an exciting place in 2023. And, usually excitement in bonds are not often heard in the same sentence. However, it was a bit of a roller coaster in the bond market last year. So what is our model seeing in terms of fixed income, and particularly in the U.S. Treasury market here in 2024?
Yeah, the bond market did offer a wild ride in 2023. Interesting, the yield on the 10-year U.S. Treasury ended the year nearly where it started, if you can believe it, around that 3.7, 3.8% range. It hit a low, though, intra-year, it hit a low of 3.3% and a high of almost 5% throughout the year. So that is a gyration.
And that's a huge move in the bond market, right? Maybe in equities, it doesn't seem like a lot, but in the bond market, that's an enormous move.
These are big moves, no doubt. Notable declines in the yield following the Fed's November statement, indicating that the end of the tightening cycle and a shift towards easing through interest rate cuts starting this year. That definitely played a big role. And given that dramatic shift in consensus, and the commensurate shift to a more positive investor psychology toward U.S. Treasuries or duration or rates, as however you want to call it, our model research indicates some lengthening duration could make sense in the near term. So this includes, from our perspective, intermediate duration Treasury inflation protected securities or TIPS as well. All that said, given the risks that inflation may persist, along with the increasing supply of government debt issuance that we've seen, we do also continue to favor shorter term maturities in treasuries as well, which are still providing that attractive yield.
Sure. Yeah, absolutely. What about corporate bond market, often referred to as the credit markets? What is the model seeing there?
Yeah, well, the inversion of the U.S. yield curve continues to signal that potential risk of an economic slowdown here. I mean, we have more of a mixed outlook now in the U.S. equity market as well. So, we don't think that's necessarily presently reflected in corporate credit spreads, which are still quite tight, particularly at the high yield. Right. So the risk of widening from here for such little additional yield over risk-free treasuries keeps the outlook for corporate credit markets just remaining cautious for the time being.
Good. All right. Shifting gears again, let's look at real assets, and that would be both gold and commodities, beginning with gold, which, as we know, I think it reached an all-time high in late December. But what is the model seeing here as we turn the calendar into 2024 for the price of gold?
Yeah, gold rallied in the fourth quarter from the low 1820s region of dollars per ounce to an all-time high, as you alluded to, of $2,077 per ounce, and finished 2023 with a gain of almost 13%. Interestingly, gold increased in value last year, even in the face of rising real yields, which isn't usually the case. They often move in opposite directions. So some reasons that gold remained attractive last year can be attributed to this very significant buying by foreign central banks who've been looking to reduce their dependence on the US dollar. Our longer term outlook just remains positive towards gold, as it could serve as this safe haven against a potential downturn in the equity markets during a stagflationary environment, and as a hedge with the continuing geopolitical risks and ongoing wars that we're seeing globally.
Excellent. All right, so let's take a look at the commodities market, and that was one of the few asset classes that had negative performance, I believe, in 2023. Probably based in large measure on the decline in the price of oil. So what are we seeing, though, in terms of commodities this year?
Yeah, no doubt. Broad-based commodity basket was negative on the year, down maybe 6% or so. You're correct that the price of oil, is a real wild card here. There's the risk of a widening conflict in the Middle East, which could certainly spike the price of oil. But for the time being, that remains at bay. Most of those conflicts are regionally located for the time being, but remains a risk. So overall, the model research, in the absence of widening conflict, views commodities unfavorably with this kind of continued weakness that we're seeing out of China, but more broadly, the global picture.
Excellent. All right, Eric, that's a wrap. Thank you very much for providing the update. Our first update for 2024 most likely proved to be another interesting year in the global capital markets, and we look forward to being able to keep our listeners informed throughout the coming year. So that will do it for Eric and me this month's edition of the 3-Edge View from the Edge. We'll be back in early February with our next edition of the monthly View from the Edge. Meanwhile, Steve Cucchiaro and I will be back next week with the latest edition of the 3-Edge Week in Review. And if you would like a hard copy of this View from the Edge newsletter for December, you'll find that on our website, which is 3edgeam.com. As a reminder, our entire library of video content always available on our 3-Edge YouTube channel. In addition, if you think someone you know may benefit from our 3-Edge videos, please feel free to share them. So, on behalf of Eric and everyone here at 3-Edge, thanks for listening.